Nothing surprises me anymore, but I will tell you, strictly from a mathematical and logical perspective, I don't think there's a better play out there whereby you can increase the amount of gold you ultimately end up with without spending any money. And in my opinion, really without, in fact, maybe even decreasing your risk, because the downside risk of silver priced at 22, 23 bucks an ounce, to me, is completely negligible. Yes, I still believe it. Yes, I still think it's as good of a deal as it ever was, or as smart of a deal, to the point where I will publicly say I think it is the trade or the opportunity of a generation, certainly of the decade.
In the early hours of Thursday's Asian trading session, the gold price showed signs of attempting a rebound, finding renewed demand around the $2,020 mark. The potential for recovery beyond $2,050 hinges on softer than expected inflation data that could reinforce dovish expectations from the Federal Reserve, potentially solidifying the likelihood of a rate cut in March. Silver exhibited a bullish trend last week with an entry point at 22.47 and a rejection candle, suggesting upward momentum. A potential break above 23.52 could strengthen the trend towards a target of 24.60. Andy Schectman, CEO of Miles Franklin, emphasizes the historical pattern where silver tends to outperform gold when catching up in percentage gains. Despite its short-term volatility, silver has historically tracked with gold over time and has often outperformed gold in a bull market. The current gold-silver ratio stands at 88:1, meaning it takes 88 ounces of silver to purchase 1 ounce of gold. Historically, this ratio has averaged around 50:1 in the modern era, with a tendency to revert to the mean over time. Acknowledging the potential challenges in acquiring gold, Andy suggests that silver remains an unmatched investment opportunity. He proposes that investing in silver could augment one's gold holdings without additional financial expenditure. Reports indicate a growing concern about a potential silver shortage, primarily attributed to a decline in the total silver supply, notably observed through production losses at major mines such as the Penasquito mine. Addressing concerns about a manipulated short position in the silver market, Andy underscores silver's increasing utility in green initiatives, digital technologies, and military applications, and its enduring role as a monetary asset. The rise in spot silver prices to $23.21 is primarily attributed to its growing appeal as a safe haven asset, amplified by ongoing tensions in the Middle East and market speculation surrounding potential U.S. Federal Reserve rate cuts. We will present clips from Andy Schectman's interview with Liberty and Finance. But before we do, if you want more videos like this, please hit the subscribe button and turn on the notification bell for more updates. Thank you and enjoy the video.
I think the argument is still as strong as it has ever been. It is still an anomaly in geological sense and an anomaly in price ratio sense going back 5,000 years. And you know, one of these things that I would call maybe the greatest calculated speculation I've ever seen. I think it's the trade of a generation. I don't say that lightly. I will be the first to admit I'm surprised it has stayed here where it has. But to what Rick had said, you know, what Rick was saying was that gold in the previous full 4 bull cycles led the way. Well, that's exactly what gold is doing here. And what he would also say is that when silver finally caught up, in terms of a percentage gain, it catches it and actually surpasses it. And when you look at silver from every single metric, aside from the fact that it holds the largest concentrated short position on any commodity traded on the exchange, which just reeks of manipulation, it is an asset that is increasing exponentially in its demand in green, in digital, and military applications, not to mention monetary, and it is decreasing in its above ground footprint. It's also decreasing in its below ground footprint in the respect that what it is used in industrial applications or military applications, it is used and it is gone. It is, you know, in terms of recycling, very little silver is recycled because it's used in such small amounts in motherboards or in cell phones or basically anything that conducts electricity or is electronic has a little bit of silver in it. Doesn't make sense to recycle it out. Or if it's used in the tip of a Tomahawk cruise missile, you know, you're not going to dig amongst a crater where the bomb went off looking for residues, silver residue. My point is that it is decreasing above ground in its industrial and military applications, and it's decreasing below ground in the respect that for 5,000 years, the ratio of 16 ounces of silver to 1 ounce of gold not only was consistent in its price, but it got that price ratio because of its geologic ratio. And so for as long as time goes back, you'll see a 16 to 1 ratio gold to silver until just recently, where guys like Keith Newmeyer, who you've had on your show, I believe, will say it's coming out of the ground right now at 7 to 1, and he would know. He's the CEO of one of the largest silver mining companies in the world and understands this. So it's an asset that is depleting in nature. It is depleting above ground, and it is increasing in its use cases. So I will still say, yes, it is. And it to me is somewhat surprising that the ratio has stayed where it is for as long as it has. And again, I will tell you that I don't see a better calculated speculation, maybe never have in my career. And it checks all the boxes and it has very little downside risk. I guess the one fatal flaw perhaps in this plan would be you do this and gold becomes unobtainium. Now, could that happen? Sure. Nothing surprises me anymore, but I will tell you strictly from a mathematical and logical perspective, I don't think there's a better play out there whereby you can increase the amount of gold you ultimately end up with without spending any money. And in my opinion, really without, in fact, maybe even decreasing your risk, because the downside risk of silver priced at 22, 23 bucks an ounce to me is completely negligible. And the one or two times that we've seen the markets in the last decade act irrationally, like we saw in 2020, where silver went down to 12 bucks, you'll remember, Dunnigan, you couldn't find a thing on the planet for, at least double that make-believe melt price, make-believe spot price. So yes, I still believe it. Yes, I still think it's as good of a deal as it ever was, or as smart of a deal, to the point where I will publicly say I think it is the trade or the opportunity of a generation, certainly of the decade. And I guess we'll have to see where the chips fall. But no, I haven't been thrown off that trade one bit.
For much of the past year, the BRICS alliance has unequivocally embraced the concept of de-dollarization, a move partially compelled by Western sanctions. The bloc has been proactive in its efforts and consistently advocated for the increased use of its local currencies as an alternative to the US dollar. The report at the center of this discussion focuses primarily on the rise of digital currencies and how they can challenge the overall dominance of the dollar on the international stage. Several countries, including China, Saudi Arabia, Russia, and India, are actively divesting from US treasuries and preferring gold. This trend, characterized by selling rather than repurchasing treasuries, erodes the dollar's hegemony. The diminishing bond purchases by these countries and the growing use of local currencies in transactions gradually undermine the dollar's settlement value, potentially impacting its reserve status over time. Notably, Andy highlights the release of the BRICS Bank's Maharaja bonds, which are exclusively available for purchase in local currencies, excluding the US dollar. This strategic move underscores a systematic challenge by BRICS nations against the West and signifies a deliberate effort to chip away at the dollar's dominance. Now let's return to the interview.
Look, when we talk about gold, it is infinite duration and finite supply. I think that's a cool way of explaining it. And when you contrast that these days with dollars and treasuries, it seems that the dollars and treasuries represent finite duration but infinite supply. That they'll just continue to print and come up with this, and to the point of $1 trillion a quarter being issued in treasuries. I mean, the amount of debt issuance is ridiculous. The amount of debt spending and stupid spending is ridiculous. And when you look at the fact that, a lot of people point to the U.S. bond market as the Achilles heel to the BRICS endeavor, that, you have to have a bond market. Well, I really do believe that when we look at all of the settlement happening away from the U.S. dollar, and also the lack of purchasing by these countries and actually selling of treasuries is beginning to chip away at the dollar hegemony, and more transactions with these countries in local currencies is starting to chip away at the settlement value of the dollar. The lack of bond purchases by these countries ultimately is beginning, I believe, will ultimately begin to affect the reserve status of the dollar little by little by little. That's my theme, this logarithmic decay. But, I think it's also important to note, and got very little coverage, is that the BRICS Bank is going to release their first swath of bonds. They're called the Maharaja bonds, and they're being made available for governments, financial institutions, and regular investors. But interestingly enough, the BRICS bonds will be available for purchases in local currencies only, not the U.S. dollar. So again, I think what we are witnessing with the dollar hegemony is death by 1,000 cuts. And too many people, again, going back to the nothing burger comments, where instant gratification is not fast enough for these people. You have to understand that if there is one model that I respect more than any from these BRICS nations, is the fact that they do things methodically. They are doing things in a way that once they rise to challenge the West to whatever degree they do, you can bet that they've dotted their I's and crossed their T's. Another 30 countries have formally applied to the BRICS. And we don't know exactly what they are. I mean, I have a good idea what they are. There's a list of them that came out. We believe it's accurate. But rather than speculating, we'll just simply say that this is a growing trend. And whether all of the settlement being done in local currencies, whether we see more and more countries signing up, or whether we see a new set of $28 billion worth of BRICS bonds that are being issued only in local currencies, little by little by little by little by little by little, and bang, all at once. Now, where is the bang? Don't know. Is it going to be this year? Don't know. I mean, you got Iran and Russia have officially abandoned the SWIFT payment system. And that's something to consider, is that, look, these are two of the BRICS members that are being sanctioned by the West. It's not being lost on the rest of the world. So much so, by the way, and here are other things that we just don't see in our Western media. Gold hit an all-time high yesterday in China. In yuan, all-time high. So the Chinese certainly notice it. And I think this is a trend that we'll continue to see.
Analysts predict a strengthening in industrial demand to bolster silver prices, setting a target of about $26 per ounce by mid-2024. Influential factors, including reduced interest rates, stronger physical investment, and rising industrial demand, are anticipated to constrict market conditions. What are your thoughts on the future price movements of silver? Share your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.